Hey, John Sellers here with ForeclosureSlayer.com and the John Sellers Group. We specialize in short sales all over Southern Oregon. Now, you're wondering if you go with a foreclosure or with a short sale, what are going to be your tax consequences? It's a great question. First, before we get started, I need to let you know I'm not a tax accountant, nor am I an accountant. The opinions that I'm going to give you are educated opinions, but they're still my opinions, and I advise that you talk to your accountant and attorney when you're trying to sort these things out. So let me give you an overview. Misconception number one. People often come to us and say, well, if I go with a foreclosure, I'm not going to have taxable situation. And what we're talking about tax here is the income that is provided to you by the cancellation of debt. Since you didn't pay income when the loan was given to you as cash given to you, if it's forgiven and not paid back, then it's considered by the government, IRS, as income, or cancellation of debt as income. But here's the thing. Whether it's a foreclosure or a short sale, you will still get a 1099. Now, you'll get a 1099-A if it's a foreclosure, which is called abandonment, is what the A stands for. On the 1099-C stands for cancellation of debt on a short sale. Now, here's the thing. You are going to have to pay more tax if you're required to if you let that property go to foreclosure, because it will sell for less money at the auction than it will with a short sale, statistically. Statistically, we're finding that short sales for the bank are netting 10, 20, 30% more, which means if the bank nets more, you're going to have less income and less forgiveness unless you're going to have to pay tax on. Okay? Now, that's the basis, but what are the other things that are coming into play? In 2007, the government put together what they call the Mortgage Forgiveness Act, and it was a great thing because it said under most situations, and again, I'd like you to go online, get this document, Mortgage Forgiveness Act 2007, and take it to your accountant. And it says that, hey, if you purchased this property and got a loan during certain timelines and you have to go foreclosure or short sale, you will not have to pay tax on that. That is covering most people that we're dealing with. Although when you've got a second, it's different, and there's certain things in there, so we do want to have you talk to your accountant. Now, the other is, and this covers even more people, if it's your primary residence, there's a few rules of if it's under $2 million, the size of the property. So those are more specifics we can talk about when we talk to you individually. However, the next one is that if you're insolvent, there's Form 982 with the IRS. Go to irs.gov, Form 982, and that talks about if you are insolvent, you will not pay tax on cancellation of debt. How do they figure that out? Basically, they look and say, what do you owe versus what are you worth? So if you owe $200,000 and you're only worth $180,000, you're insolvent, and you will not have to pay tax. So I hope that helps giving you a basic overview. It's probably not as scary as what you thought it was going to be. We're finding the majority of our cases, our clients are not having to pay tax on the cancellation of debt. We'd love to talk to you more. You see a big button up there above my finger where it says Get Help Now. Go there, get some help, fill out the form. We'd love to meet with you. Email us questions. But more than anything, gather some more information. We're just happy you came to the website. Thank you. Have a good day.